Hi, David.
Hi, John. How are you?
Good, how are you?
Good.
Thank you for joining us.
Thanks for having me.
So to start, why don't you introduce yourself and the team that supports the strategy?
Yeah, sure. So first off, my name is David Schuster. Been at Brown Advisory since 2008. I joined really to start the small cap value strategy. Been running and managing that strategy since then. So a long time, supported by a great team of analysts. The analysts are kind of across industries, have a wide range of experience and expertise. And generally, as you would think of on a value strategy, tend to be the ones that are more skeptical, really valuation oriented.
So from there, why don't you briefly describe the strategy's investment philosophy?
Philosophy really has kind of three key tenets: free cash flow, capital allocation, and valuation. That was really what we laid out when we first thought about starting the strategy. The free cash flow really kind of came from, an observation that we had that there's a tremendous amount of M&A activity in the small cap space. And so we really thought about what drives value in those transactions, what prompted people to actually do transactions, and ultimately it's free cash flow. The second piece would be capital allocation. Clearly, we're very concerned about what our management team and boards are doing with all this cash flow. We spend a lot of time with them as part of our due diligence process, and even after we've made our investment, making sure that they are really adhering to what we think is best-in-class capital allocation. And then finally would be valuation. Clearly, we're a value strategy focused, trying to find these opportunities at what we think are really inexpensive valuations.
So with that background, briefly describe the investment process.
First off, it is a big universe of companies out there. Depending on the study that you look at, there's anywhere from 4,000 to 6,000 companies in the universe, depending on what you include and what you exclude. And so trying to sort of narrow that down is really, really important. Our process is a little bit different. We have sort of a recognition that there are going to be a lot of companies that might look quite expensive in a valuation screen, but in fact are quite inexpensive when you roll up your sleeves and do real fundamental work around the balance sheet and the valuation. We intentionally keep a very wide funnel at the front end. And the way we execute that is really just having a very aggressive outbound calling effort. Any given year, we're probably doing 250 to 300 calls, outbound calls, to small cap companies across the team. And really what we're trying to do is we're trying to figure out, okay, is this a company that we think is really worthwhile, has those three attributes that we're looking for to really continue during the due diligence process. That's really the first and most important part of the process. As a portfolio manager, I'm really, really involved in that process, both in terms of finding new names and working with the analysts to try to assess what are we really going to work on. At that point, the analyst really engages with the management team, doing due diligence, company visits, company calls, and so forth, and that really culminates with a financial model and a memo that really sort of states our investment objectives. And if there's a real place for it, for the investment in the portfolio, at that point, we really make the decision whether to put it in the portfolio or not.
So from there, why don't we talk a little bit more about the differentiating characteristics of the investment approach?
Yeah, I think the first really sort of starts with philosophy. If you think about value managers, that could mean a lot of different things in the value space. There's a wide continuum, from very deep value all the way to sort of almost core-ish. Some people use the term, sort of higher quality, maybe as exhibited by return on equity or return on invested capital. Those would definitely be characteristics of the portfolio. But really, the philosophy is, I wouldn't say it's unique, but it's definitely differentiated within the value space in the sense that we're not looking at what might be other traditional value categories. So think of turnarounds, think of reversion to the mean, those types of situations. Certainly understand why those might be appealing. We just find that in the small cap space, there's enough opportunity out there that we really don't need to go there. We can basically pick our spots where we think we have a much more attractive risk-reward ratio.
So we've talked about philosophy, we've talked about process. Maybe expand on portfolio construction. What are some typical portfolio attributes for the strategy?
By design, the portfolio has between 60 and 70 investments at any given point. Even within that, so it is a relatively concentrated portfolio, but even within that, we spend a lot of time focused on the top 10. So the top 10 weighting is really important. And really the idea there is we can have even more concentration depending on individual investments that have a really attractive risk reward that we want to allocate more capital to. We do have a rule that no position can be more than 5%. fill it at 5%, it really starts to have too big of an impact just on day-to-day performance of the strategy. And we don't have any hard and fast rules relative to individual subsectors. So sectors, we are sector agnostic. We're very comfortable being significantly overweight or underweight a particular sector. And then finally, we do have a rule that we can't have more than 5% cash in the strategy. Really, that's born out of the idea that our investors are really looking to use us as part of a broader portfolio to really give them small cap value exposure as compared to us sort of trying to overlay our views on the economy or where we are in a cycle.
Provide a little more detail on how the strategy performs in different market environments.
Sure. So if you think about the characteristics of the portfolio, high free cash flow, a real focus on balance sheets that goes with our valuation process. That really also means that we're also looking for companies that typically have a very low leverage, so have really very clean balance sheets. In certain types of environments, those types of companies, from a philosophical perspective, just do really, really well. So when the economy looks troubled, when things are choppy in the market, those typically do really good in terms of downside protection. The flip side, unfortunately, is also sort of true. We've had a number of periods since inception where, sort of off the bottom, those types of companies are, for over a short period of time are actually really out of favor. So we typically think about the strategy doing well in choppier times, more stable times, and really the one time that performance would typically lag would be sort of periods of significant appreciation for small caps.
So maybe bringing it all together. Why invest in small cap value?
I really believe that they are a core asset class. You look over a long period of time, small caps have generated incredible returns. They tend to be in favor or out of favor for periods of time. But when they're in favor, the outperformance is quite significant relative to the broader market. So I believe that specifically that it's an important part of any client's portfolio. And I think in particular, small caps and certainly the kinds of companies that we invest in have a really unique profile.
And to finish up, tell us one thing that people might not know about you as an investor.
Well, I have a little bit of a differentiated background. My background was doing investment banking, doing mergers and acquisitions, but even before that, out of college, was an officer in the United States Army.
David, thank you so much for your time.
John, thank you so much.